Hello friends, are you worried whether the US markets decline on late Friday will impact the Indian markets? Do you know what the impact of pruning of the LIC's IPO, which is being reported in some sections of the media, could mean for the market? Or what will be the impact of Indonesia deciding to ban the exports of crude palm oil? If these factors are either worrying you or not known to you, in my video, I'm going to help you tackle the market in our own unique style using our own exclusive in-house indicators that you will not find anywhere else on the internet. I'm Vijay Pambwani. I'm a trader since 1986 and I'm here to help you to make sense and sensibility of the intricacies of the market and help you to stay ahead of the crowds using very easy to understand statistical data-based indicators. Let's dive right in, and coming up on your screen is the chart of the United States Dow Jones Industrial Average, known as the DJIA. What you are seeing is a big red bearish candle on Friday. That's a humongous candle, and Thursday also saw a big decline. Now, what is noteworthy about this chart is that the red line, which is a 200-day moving average, was cut downwards by the green color line, which is a 50-day moving average. Now, the significance of this moving average is that the 50-day moving average indicates the medium-term holding on cost of a buy and hold delivery based investor, and the 200-day moving average indicates a holding on cost of a long-term delivery based investor. So when the 50-day moving average crosses the 200-day moving average downwards, it tells you that the medium-term investors are going underwater or at a loss and are likely to bail out or push out of their positions and create pressure on the prices. This phenomena is called a death cross in technical analysis. So in the month of March, the Dow Jones witnessed a death cross, but the markets pulled higher and gave a relief rally, or what is known as a dead cat bounce. So this dead cat bounce deluded people into thinking that the death cross was negated. But here again, the death cross is very much back in the reckoning thanks to declines on Friday. And if at all this is to accelerate, the death cross will again get reconfirmed. Let's now take a look at the Nasdaq index. This is a technology index, and what you are seeing is that the death cross, which I have marked on this chart, was made on 3rd of March 2022 and was not negated because the 50-day moving average never really went above the 200-day moving average. Sure enough, the price went above the 200-day moving average, but that was at best a dead cat bounce or a relief rally. So my friends, what is the implication for India or Indian markets? The fact remains, as I pointed out in my video, thumbnail of which you're seeing on your screen right now last week, that the Indian markets were likely to remain under pressure, and thanks to the pressure from the Nasdaq index, Indian technology stocks were likely to feel the heat, which they did, which you saw them come under pressure because the overseas markets were bringing Indian markets down. Let's not forget that the Americans are one of the largest FII, foreign investment institutional investors in the Indian markets, and the American financial markets control almost approximately 40% of the global financial markets turnover. So any major decline in America cannot be wished away. You will feel the impact in the Indian financial markets as well. Should the American market stabilize and even bounce back, sure enough, even our markets will follow suit. But if this is the kind of decline that we saw last week is likely to continue even by half that magnitude, remain under no doubt that there could be some declines here. Now, the second aspect that I talked to you about, the LIC issues possibility of being pruned. Now, Money Control and CNBC have been flashing indications that there is a possibility of the LIC's IPO being pruned to less than half its original expected size, to almost 30,000 crore rupees in value. And let's not forget, there have been various attempts to push this issue through. Investors and LIC policy holders are being messaged to subscribe to this issue, which is a good thing. The FEMA is being tinkered around with so that the foreign investment institutions can buy more and more of the LIC IPO. But with the pruning of the size of the issue, two things will happen. Number one, the disinvestment target will basically come under pressure. And number two, as long as the LIC issue was still in the works, it was expected that the markets would get support from Big Brother, and therefore the bulls were a little gung-ho. But now with the pruning of this issue, there is likelihood of psychological pressure coming in on the bulls. The third aspect that I promised you I would talk about is the Indonesian ban on exports of crude palm oil. Now, if you are a Mumbaiite and a Mumbaikar will eat a vada pav or has at least seen what a vada pav is. Now, the oil that is used in frying these vada pavs are the crude palm oil variety. Now, most people think that crude palm oil is just an edible oil. It's not. It's a very versatile oil. It can be used as a lubricant for automobile engines. It is used as a base for shampoos and soaps. It is used as the basic fat for your medicinal or cosmetic ointments. It goes into food, obviously. Since it is combustible, it is also used for mixing with petrol and diesel as combustible oil, what is known as petrol doping. With the price of crude palm oil going up, because Indonesia and Malaysia, both these countries put together, are roughly responsible for 88% of the global exports of crude palm oil. All right. Now, if Indonesia is clamping down on crude palm oil exports, I think edible oil prices are likely to go up. All right. So this is likely to lead food inflation in India even more higher. If my viewers are also connected with me on social media, my contact coordinates will come at the fag end of this video. You will know that since many quarters, I have been warning you that the Food and Agricultural Organization, which is a subsidiary of the United Nations, has been issuing dire warnings about food inflation going through the roof after the COVID lockdowns were lifted. And let's not forget, the worst kind of inflation is food inflation, because consumption of food is non-negotiable, it is inflexible, and it is a priority item. So before I go out there and buy a watch or a pair of shoes, I would first like to see my kitchen stocked. Only after I have fed myself and my children will I go out there and buy stocks. Now you know what I mean. So from 28th of April onwards, Indonesia is clamping down on exports. I think food inflation is likely to feel the heat, and so will the financial markets. That done, now I start with the regular aspect of the video, and diving into the video, let's take a look at the daily, the weekly market roundup window. What you are seeing is that the bank Nifty fell more than the Nifty 50. Hey, no negative surprises here, because I warned you in my last week's video itself, remember, that bond yields and the inflationary worries were likely to hit banking stocks more. And what we saw was even gold and silver declined, because the mighty US dollar index, or the DXY, closed above 101 levels. Now, this is not a level seen since March 2020. That means just before COVID-based lockdowns were imposed all over the world. Now, a rising US dollar means that anything and everything that India imports, and do remember, India is a net importer, will become more expensive. And this phenomena is called imported inflation. So, inflation is likely to go up. based on the US dollar index itself. And remember, food inflation is as it is rising. And which is why a rising dollar is always negative for emerging markets, including India. And since the dollar is higher, gold and silver prices came down. Crude oil prices mercifully came down, which cushioned the markets. Natural gas prices have also declined. And what we have seen is that the United States dollar versus the rupee, the USD INR, also rose a little more than 0.25%. Now, the 10-year benchmark bond yields eased marginally to 7.17%, 7.17%. And the NSE market capitalization, which means the value of all listed shares on the NSE, fell by a little under 1%. That's a minor mercy again. MWPL, or the market-wide position limits, which shows what is the percentage exposure actually utilized by traders versus the SEBI allowed maximum positions which are set as a limit. So that MWPL rose to 28.23. We are going to examine that a little more in detail. And the overseas cues, do remember that I discussed the Nasdaq and the Dow Jones chart with you. Do remember all the three indices, the Dow, the Nasdaq, and the broad-based S&P 500 were down, and down by a good margin. Now that exerted pressure on the Indian markets. Now on your screen is the MWPL daily chart of 20 days. Do remember that the days of 32 to 34% MWPL utilization at its peak before a derivatives expiry came along are over. That ended in November itself. After that, the market have seen MWPL peak near or below 30%, which means the two Marshmallow traders' risk appetite is definitely contracting. What is the Marshmallow theory? I've explained to you in this video. Don't worry about the hyperlinks to this video. They are there in a pinned comment below this video, as well as in the description below this video, and they'll appear in the end screen as well. Now moving on to the weekly chart of the MWPL itself. Note how the MWPL has risen, but here again, we are still definitely far below 30%. Do remember that the coming week is an expiry week, and therefore MWPL is unlikely to go up significantly. There will actually be a tendency to unwind or square up positions ahead of the expiry rather than build fresh positions. So risk appetite is definitely falling. Now let's take a look at the volumes of the index futures as well as the individual stock futures. What we are seeing is that volumes have improved week on week basis on this daily chart of 20 sessions. Both the index and stock futures volumes have risen, which again is a negative sign because markets actually fell last week. And when markets fell with higher volumes, that tells you that there was actually higher participation. This time by one Marshmallow traders. One Marshmallow traders are people who square up their positions intraday and don't roll them forward. You can see the Marshmallow theory in the video that I pointed out to you earlier. Going to the weekly chart, what we are seeing is the index and stock futures turnover rose together, but the stock futures turnover actually rose much more sharply. That tells you that there was stock specific activity and action by traders. They were willing to short the market aggressively where individual stock futures are concerned, and rather than panicking, they were actually profiting from shorting the market. That tells you that the markets can lead lower. Now let's take a look at the current month basis. Basis is nothing but the premium enjoyed by the futures over spot. Basis of both the indices, Nifty and Bank Nifty, has contracted. Part of the reason, of course, is that expiry is around the corner and nobody is paying a very high premium for a few days left to expiry. But the way the basis has fallen, it would appear that there has been unwinding of long positions and even selling at higher levels. The Nifty is actually 5.8 rupees premium to spot. And if it goes into inversion, by inversion meaning negative zone, it would mean that the short seller is willing to pay a premium to go short. Now, that exactly is not very good news. Do watch for inversion, and don't forget, don't worry. All these studies that I'm sharing with you, these are in-house studies. I update them on my social media accounts every single day at the end of the day, maybe late at night, but every day. And if you connect with me on social media, I can help you become a far better trader with extremely simple but accurate in-house studies that I update on my social media accounts. Now let's see the basis chart on a weekly compression period for 20 weeks. That's 4.5 months. You can see how the bank Nifty basis has collapsed. Do remember a fortnight ago I told you that the sharp spike in the basis of bank Nifty seems unsustainable. This is not something that can last too long. And sure enough, the basis has come off. And even the Nifty basis, which was rising steadily for approximately 9 weeks, has now come off. It surrendered almost 2 months of gains where the basis is concerned. And that tells you that there is a little bit of fear in the market. Let's now go to the advanced decline ratio, a very simple but highly accurate metric where we measure the number of shares advancing versus the number of shares declining. Only one day last week, we saw the advanced decline ratio being positive. Otherwise, it was below 1. That means the number of shares declining were far higher than the number of shares rising. And that's not exactly very good news. Now, the advanced decline ratio on this daily chart shows that the ratio is almost at the lower end of the 20-day period. Now, I'm switching you to a weekly chart for better perspective. Look at how we are almost at the bottom of the 20-week or 4.5 month range. That tells you that one Marshmallow traders are actually showing very little conviction to buy. That's not exactly very good news. Let's now go to the impetus chart. This is something that you've been loving for almost a little less than a year now. You've banked on it, you've depended on it, and the kind of feedback that I get from you is extremely encouraging. Thank you for the same. What we are seeing is on a week-on-week basis, the impetus on both the indices has risen, but it is the bank Nifty's impetus which has risen faster. Do remember what I told you a fortnight ago, that both the indexes impetus was falling, which would mean at any given point, just like a compressed spring is let go and it shoots in any direction, there would be an explosive move and the impetus would rise with it. Now, unfortunately for the bulls, the impetus has risen with a decline in the markets, which means more volatility ahead, possibility of further declines ahead. I now move you to the weekly impetus chart where you can see with a little broader view and a macro view of the impetus reading as to how on a week-on-week basis the impetus has risen just when the markets fell. Friends, this is not exactly very good news. So do watch out for volatility. It will rise sharply, and volatility, as you know, is a knife that can cut both ways. It either gives you a lot of money, or more fearfully, it can also take away a lot of money from a trader. So trade very, very carefully. Now let's take a look at our new indicator, the LWTD, the lift, weight, thrust, drag indicator. This happens to be a daily compression mode of 20 days. What we are seeing is that the Nifty, shown as a blue line, is plunged into the negative zone, but the LWTD has gone up above zero. Does it mean that the market is going to rise? No, because the price is the most important factor in anything at all. In financial markets, the price is the price and there's no fighting the price. But what does the LWTD tell us? It tells us that at sharply lower levels, there could be an attempt by the market to resist further declines and possibly pullbacks towards the end of that particular trading session may be seen. So this is a daily chart. This is valid more for Monday's outlook. I now take you to the weekly chart, which has a slightly longer term perspective and therefore implications. Now let's take a weekly chart of the LWTD. What you can see is that the Nifty's percentage gain loss line is below zero, but the LWTD has risen. Here again, what it means is that during the week, the price, of course, is remaining under pressure. There's no discounting that. There's no fighting or disputing that. But at lower levels, there is a fair probability that the markets will resist the decline, and the low that is made during the week, the closing may be respectfully and definitely by a big margin higher than the low of the week. Unless, of course, there is any unforeseen circumstances, act of war, Ukraine, some other factor, of course, the US market suddenly collapsing. We don't know that yet. But going by the data that we have at hand so far, it looks like that the markets will end off the intra-week low by Friday in the coming week. I'm not saying that it'll close in the positive. The price does remain under pressure. We don't know that yet. Now let's take a look at the footprint of the four types of investors in the market. I start with the FIIs. The arrows are not showing you the absolute position on a week-on-week basis, but the outlook of the player. So here the FIIs have basically raised their individual stock futures and they're optimistic on them, and where their short positions are concerned on the index futures, their shorts have reduced. Therefore, their outlook is a little more optimistic. Therefore, the arrows are up. Now for the DIIs, the domestic investment institutions, on a week-on-week basis, what they have done is increase their stock futures shorts. They are seemingly more pessimistic. But where their index futures are concerned, they've squared up some of their shorts on index futures, so they seem to be optimistic here. Prop traders, these are super sharp brokers own trades, since they are next best to insiders because they know who's buying what and how much and at what price, because all the trades are routed through them. They tend to be second best after insiders. What they have done is reduce their individual stock futures longs. Therefore, there's a red arrow. And they have also increased their index futures net shorts. That tells me that the brokers are actually betting the market will fall or at least remain under pressure. Now the fourth category, retail traders. Now these are guys who've done all the heavy lifting so far in the market. What do they feel and what are they doing? They've increased both their stock futures positions as well as index futures long positions. So they seem to be under the of the outlook that the market should go higher. What it will mean is that this optimism being built by way of fresh commitments on the long side, if this optimism is negatively surprised by Monday's closing or any act of war or any unforeseen circumstances, will result in panic-based unwinding of long positions. And that means volatility going up again. So my friends, in the coming week, any which way you look at it, the market appears to be heading towards higher volatility. Friends, the indicators done, I now move to the bond markets where the bond yields have eased slightly, just about slightly, but they remain comfortably ensconced above the 7% mark. Now that means that the markets are expecting higher inflation and the higher possibility of a rate hike in the early June Monetary Policy Committee or the MPC meeting of the Reserve Bank of India. Now, I am very enthused about the fact that a lot of my friends who have encouraged via social media to open an account with the Reserve Bank of India on the Retail Direct GSEC scheme, where trading is free, buying and selling of government bonds is free, have locked in gains of over 7.25% or 7.30%, 100% government guaranteed investments as against 5.5% in return in fixed income. I will continue to provide you with many such ideas about how to get higher interest rates with a government guarantee. Unlike a bank account where only 5.5 lakh rupees is guaranteed, I am always seeking opportunities for me and my family and of course our corporate body to invest with 100% government guarantee where the capital is protected by the central government. So do continue to invest in the RBI Retail Direct GSEC platform. The yields are getting mouth-watering, and you should continue to resort to laddering that I have told you so many times on social media. Friends, bond yields done. I now go to the US dollar index, which was one of the 3 pressure points last week. If at all emerging markets fear something, it is a rising dollar. The 1997 Southeast Asian currency crisis taught us when countries' currency weakens against the US dollar, their forex debt and inflation both become unmanageable. And the US dollar, as you can see on your daily chart on your screen, has closed above 101 for the first time after March 2020. The dollar index, or the Dixie as it is known, rose on 4 out of 5 trading sessions and stayed comfortably above its 25-day moving average, which is a proxy for a month-long holding on cost of an average bull. So the short-term outlook still remains optimistic. The bullish trend line, which I have drawn in late May 2021, which means that trend line is approximately 11 months old, is providing fantastic support to the US dollar index. Switching on to a weekly chart, what we are seeing is that the price is significantly above its 25-week exponential moving average, which is a 6-month-long holding on cost. And we have seen 3 consecutive green candles, which means the rally has now spanned over 3 consecutive weeks. Now, this is a sign of strength in the dollar and therefore sign of weakness in emerging equity markets, including India. So if the dollar index continues to rise, do remember most companies who have taken a lot of foreign exchange debt, loans in US dollars, their stock prices will come under severe pressure. Can you short them? Yes, you can. Google search the list of which companies have the highest amount of dollar denominated debt and you'll know what to do. Now, last week, I advocated a range between 101.80 on the upside and 99.15 on the downside. What we are seeing is that kind of a level held, the range held beautifully. In the coming week, I expect an estimated range between 102.5 on the upside and 99.75 on the downside. Like I said, please do keep a hawk eye on the US dollar index for signs of what to do with commodities, currencies, and equities. Friends, the US dollar index done, I now move to the bank Nifty, which lost 3.79% last week and bore the brunt of all the selling. It fell, as you can see on the daily chart of your on your screen, on 4 out of 5 trading sessions and is nearing a month-long low price. Now, this puts pressure on those people who've initiated long positions in options and futures and have rolled over their long positions on the previous expiry. As the expiry week is here, they have to now decide whether to pay another month's cost of carry or rollover cost or to square up their long positions. If they choose to square up their long positions, which they might, it can lead the market lower. Do remember that the index, the bank Nifty, is trading below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. So there is a mark-to-market problem for long position holders. And even the 25-day exponential moving average is tilting downwards, which means more pressure. Now let's take a look at the weekly chart of the Bank Nifty. What we are seeing is that the price has closed convincingly below its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. Now, the guys who bought the Bank Nifty 6 months ago and rolled over their long positions month after month are now underwater. Do note how the 25-week exponential moving average itself seems to be flatlining, which means going sideways. So, over the last 2 to 3 months, the Bank Nifty's exponential moving average hasn't gone anywhere. The bull hasn't really made too much money, a buy and roll over bull. All right. So, can a serious correction come in? That's always a possibility. This is the first time after the rally started in very, very late March 2020. And there was a spectacular run up for almost 7 quarters. That seems to be slowing down sharply. Statistically speaking, we are nearing the first serious correction after almost a year and a half long rally. So you need to be extremely careful out there. Now, in the week before last, this index was number 4 on the most volatile counters list. Now, that's not very healthy. An index being so high on the volatility list tells you that the retail trader is going to feel higher and higher challenges in trying to make money. All right. But last week, it rose one more notch to hit number 3 on the most volatile counters list on the NSE derivative segment. So, my friends, I would urge you to be even more careful because the market is getting even more challenging. Last week, I advocated a range between 39,300 on the upside and 35,600 on the downside, which held perfectly well. In the coming week, I expect a range between 37,850 on the upside and 34,200 on the downside. Friends, the Nifty done, I now come to the Bank Nifty done, I now come to the Nifty 50, which is the most liquid and low impact cost trading instrument on the NSE currency, the derivative segment. Now, this index relatively outperformed the Bank Nifty by falling 1.74% versus 3.79% that the Bank Nifty fell. And as you can see on the daily chart on your screen, this index also fell on 3 out of 5 sessions, whereas the Bank Nifty fell on 4 out of 5 sessions last week. So to that extent, it is showing relative outperformance or higher relative strength versus the Bank Nifty. But that is not to say that this outperformance will continue. There is no guarantee. If the effect of Friday's sell-off in the US market continues, then there would be very little place to hide and almost everything will fall. All right. The price has now closed below its 25-day exponential moving average, which is a month-long holding on cost, and the average itself is turning lower. Here again, the same quandary, the same problem of choice to a bull will apply because we are now in an expiry week. Whether to roll over your long positions and pay cost of carry once more, or to square up your long positions at a loss and say this far and no further. So the MWPL, which I update on my social media accounts every day, will give us a hint of what is happening. Do connect with me. My contact coordinates will come at the fag end of this video. I now move to the weekly chart of the Nifty 50. What you are seeing is a doji, a very small bodied candle, and fairly large and prominent shadows or wicks on both upside and downside. Now, what we see is that the price has closed below its 25-week exponential moving average, and the exponential moving average is flatlining, just like the Bank Nifty's case. So, if at all there is further significant decline, here again, the exponential moving average itself can start to slope downwards, which would mean this is the first serious correction after the rally started in late March 2020. So we need to be extremely careful. Look at the three peaks made in this chart here. First in October, then in December, Jan, and now we are making a peak in the month of March and coming down. So if at all we fall below the previous swing low, or maybe even violate 16,400 odd levels, the bulls will come under some amount of strain. In the week before last, this index was number 13 on the most volatile list, but it rose 2 notches to go to number 11, which means volatility going up is raising the challenge level for a retail trader. So my friends, it's time to be careful, lighten up on commitments, and play with a diligent adherence to stop losses. Last week, I advocated a range between 18,125 on the upside and 16,825 on the downside. Do note how perfect was that level, that range, because the low made by the Nifty spot was exactly 16,825. We strive in our statistical model, the IBEX, to provide our friends with as many super sharp, super accurate set of parameters for free while using our YouTube and other social media accounts to help others become even more profitable traders. It gives us a great deal of satisfaction when our friends make a lot of money and say, hey Vijay, we used your so-and-so parameter and we made money. Keep it going. Let's all help each other become more sharper and profitable traders. In the coming week, I expect estimated range between 17,800 on the upside and 16,500 on the downside. Do note, if the volatility escalates sharply, there is a real possibility of the ranges being violated, possibly on the downside. So stay sharp, trade light. Do note that expiry weeks are, as it is, high volatility, and now with the US market coming down, LIC's IPO being possibly pruned, and food inflation rising thanks to Indonesian curbs, there is extra bit of nervousness in the market, and MWPL, or the risk appetite of two Marshmallow traders, has come down sharply. So be very, very careful and stay sharp. Possibly square up your positions on the same day if you don't feel comfortable rolling them over. Friends, the indices done. I now come to the most popular segment of the market, where I give you 5 stocks, high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks, low beta, low impetus, where you take large exposure, wait for small price moves to make your money. Why the difference? Different traders, different mindsets and attitudes, aptitudes, so different tools out there. All right. So here goes. The high beta list is led by Jubilant Foods at number 1, Manappuram Finance number 2, number 3 Cipla, number 4 Biocon, number 5 L&T Infotech. Low beta, low impetus stock list is led by Metropolis, number 2 Torrent Power, number 3 Ashok Leyland, number 4 Bharat Electronics Limited BEL, and number 5 AU Bank. Friends, these hierarchies of high and low beta stocks can move or change hour to hour and day to day, which is why you must connect with me on social media so we can update each other with what's happening in the market. And these are not pure buy recommendations. These are trading calls. How will you know whether to trade this on the long or short side? I've explained to you in this particular video. Here again, the hyperlink will be there in the pinned comment below this video and the description in the space below this video itself. Friends, before I wind up this video, I request you to subscribe to my YouTube channel. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I always welcome your comments, and please help us to reach out a wider audience who love to have rational logic and objective study-based trading patterns by referring my video to your family and friends. You would be doing us a good deal of help. I thank you for your patience, my friends, for being with me in this extra long video. Till we meet again in my next, this is Vijay Bambani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.